The other day I found this article that claimed that mortgage applications dropped by 12.2% and have been dropping for the past 4 weeks straight. Hi YouTube, it's Yashi, and in today's video we're gonna analyze some mortgage data, see how it will affect the home buyers and the home sellers, and what you can do about it. But before we start, please like and subscribe to bless the YouTube algorithm. Also, always remember this is not financial advice, please talk to a professional when it comes to investing. Last week the Fed spoke, and although they did not raise their interest rate, they still stated that they will do so in the short-term future. You need to understand that mortgage rates are based on multiple factors. On one side we have the Fed base rate that is decided on a centralized way. On the other, we have more uncontrollable factors like the bond yields, which is based on the supply of bonds and the demand by investors. Because investors have been generally fearful in these couple of days, number one, because they thought the interest rate would rise, and number two, because there's general fear across the market, they forced these bond yields to change, which negatively affected the interest rate on mortgages. Yes, they still rose. The article mentions an increase of interest rate from 3.64% all the way to 3.72%, which doesn't seem like a lot, but let me make you an example. Interest is the cost of borrowing money, and it has to be multiplied to the amount of money that you owe to the bank. So if you owe $500,000 in mortgage, an extra 0.08% would still mean an extra $400 that you would have to pay in a year just in interest. $400 in a year might not seem like a lot, but you need to understand that this change we just saw in this article happened in the course of 1 week. If we look at the bigger picture, interest rates throughout the past couple of months actually increased much more. From an all-time low of 1 year ago at 2.99% on a 30-year loan, all the way to the 3.4% a few weeks ago. These multiple small increases we saw in the past couple of months led to a total increase of 0.73%. So if we take the same example in concern with a $500,000 loan, we add another $3,650 of interest in a single year. So how did all this affect the market? Well, number one, of course, we had a big drop in mortgage applications, 7.1% just in the past week. According to the article, one of the biggest week-by-week changes we saw in the past couple of years. If we look a little closer, the news is not as bad. Most of this drop was caused by less applications for mortgage refinancing. Basically, people owning already a home with a mortgage and refinancing the mortgage to get a better deal. But if we look at home buyer mortgage applications like FHA, VA, standard loan, etc., we notice that there's either a little drop or no drop at all. This means we still have a very strong army of buyers in the market. And here's why we still have a lot of buyers. As you may know, home prices went nuts, but at the same time, because of low interest rates, homes are still affordable. Let me make you an example. 2 years ago, I bought my first rental property for $105,000. I got a 15-year loan, so the interest rate was very low. If I did a 30-year loan, my interest rate would have been around 4.1%. If I would have chosen that option, my monthly payment would have been around $501 a month. You need to understand that I did some improvements to the apartment, so it's worth much more than what it should be worth. But if I left it as it was, it should be worth around $120,000. Just believing it as is and let the market raise its price without doing anything. If we take that historically low 2.9% interest rate on a $120,000 loan, our monthly payment will be around $520. It's a little bit more, but it's not dramatically more, so the house is still affordable with a higher price but lower interest rate. So yes, prices went up, but affordability still remained pretty stable because interest rate went down. So we know we have a lot of buyers, we know that home prices are going up, and we know that interest rates will also increase in the short-term future. So what does this mean for the next couple of months? Higher prices and higher interest rates means lower affordability. If we take that $120,000 loan and increase our interest rate to 4%, payments will go almost up to $600. That's almost a 20% higher monthly payment than on our original example. Worse affordability means that we will have more buyers getting kicked out of the market and a lower amount of buyers for the same amount of sellers that will have to compete to sell to the same amount of buyers. And these sellers, either they have a top location property or they need to drop their prices to become more competitive for the buyers. We also need to add a very big factor that in the top markets in America, we have 1.5 million homes in construction right now, which will flood the home market. And again, with affordability going down, the amount of buyers going down, and more homes coming in, this could trigger a chain reaction. Getting a loan will become more expensive, less buyers will be out there, a lot of new construction homes will come out on the market, and all these homes now will have to compete for the same amount of buyers. On top of that, a little detail, building companies have to pay contractors for the work and everything, so they have to sell their homes in a timely manner. That stress could drop prices even more. The question is by how much? The second question is also, is this going to happen across all of America? And here I can say I don't think so. Most of the construction is happening in specific areas. We're talking about Austin, generally Texas, Florida, some of California, smaller untouched markets like the Midwest or West Virginia. I recently just bought a duplex down there for $40K. Might be touched on a macro level because the whole market might be crashing, but on a specific market level, there wouldn't be too much of change because the price is already so low, it cannot really go lower. And then we also have specific markets like Northern Virginia, where the influx of people is so high that no matter how high prices go, there will always be demand for homes. Also because construction here is not as strong as in markets like Austin, California, or Florida. And the last thing you never need to forget, being in Northern Virginia, it's all government workers, and unlike private companies, the government hopefully never dies, it just increases its debt. So no matter what, any crisis like it happened in 2008, this market is still pretty resilient. So what should you do? Should this stop you from buying homes? Well, yes and no. If I were a home buyer, which by the way I still am, but more from an investing perspective, I will still keep on looking at the market on a daily basis and look mostly for homes that give me a little hedge. When I say hedge, I mean finding a fixer-upper home or a house with some land with the potential of building another house or something like that that enables me to increase the value of it, possibly at a price that is lower than market. Let me make an example. Supposedly the average price of a home in a specific area is $200,000 and I'm able to find a trashed house for $150,000. This is very optimistic, but let me make the example very clear. Supposedly, I can fix it with only $10,000, which makes my total cost $160K for a house that is now valued at $200K. And now supposedly that the market drops by 20%, so in this case, $40,000. All the homes lost $40,000 in value. My home that I paid $160 and it was worth at market now, so $200,000, is worth $160 now. So I lost zero money and I'm not underwater, so I can still survive over the long term. So if I need to free up money, I can sell it with no profit, so I didn't lose money. Or if I holding for the long term, I can do it easily without having lost money. I can pull out equity with no issues and live comfortably. The question is, how do I find these deals? Well, number one, what I would do is search daily on Zillow and Realtor.com for 10 minutes in the area that you like and do it on a daily basis. Try to figure out what the average values of homes are so you get a good grasp of the market. Secondly, partner up with a realtor that focuses on these types of properties. Because if you now know how the market works, a realtor can help you find deals before they get on the market, because a realtor has access to the listing service map. They can see homes before they hit the market, so they can warn you and tell you that they got something before everybody else can see it, and prepare you to potentially make a move as soon as that home hits the market. If you're in Northern Virginia, I specifically focus on these type of property because I'm an investor. You can either hit me up on Instagram or on my email. You can find them also down in the description below. I hope this gave you some good insights about the real estate market. Let me know in the comment section what you think, and if you have other ideas or if you would like me to go deeper into specific topics, I might do a video about it. Thank you for watching. Ciao.